in a particular quarter, there can be many numbers of extreme return. But if I follow the block maxima, then this will not capture the financial return series characteristics. So that's why I will use the peak over threshold method. Now this is the peak over threshold methods. Ultimately, var quantile can be measured with the help of this peak over threshold method is one. And what is the component guards model? Component guards model, first I will use alpha 1 model, then I will use this component guards model. If I have the time, or means if you ask the question, then I can discuss these things in details. So what I will do, I will discuss the this is the copula functions. Copula function, what is it actually? This copula is a function that joins, or this theory dates back to slab. We hope that a joint distribution can be factored into the marginal and a dependence function called copula. So what I will do it here, if I take two series from one market.
Go ahead and present your paper, please. Thank you.
Okay.
Because it was so.
Sure.
So much.
And no, well, I'm pretty sure I misunderstood.
Yeah, that's what I
also.
thought. I think it might be better if you had a chat after.
Oh yeah, definitely. If you have time, because you're like the star of this conference, you present 3 papers in the in this conference.
No, definitely. Thank you so much for taking so much time. I'm sure you took more time on that than I am writing the paper.
Okay. Well, if it can help, I'll be very happy.
But it's a fun because I have to pay for it. Let's start with you.
Okay, so this paper is titled "The Informational Content of the Loan Market: An Equity Portfolio-Based Approach." It's a collaborative work with a colleague from Université Laval, Stéphane Chrétien, and a colleague from Sherbrooke University, Frank Hoggins. These are Canadian universities, in case you're wondering, from the eastern part of Canada, Quebec province, so they're French-speaking universities. My area of specialty is financial institutions, and my co-authors are the experts in portfolio management. So you'll see where we sort of combine our knowledge, if we can call it that, with this paper. And usually I have one of them with me in the room when I present the paper, because when there are some questions in how we build the portfolios and everything, I can sort of redirect the question to them. But today I'll do my best to answer all the questions you might have. So as highlighted in the title of the paper, we're interested in the informational content of the loan market. So we know that information is crucial to investors. It can help us to evaluate the performance and risk of firms. However, the sources of this information is varied. We can use information from another asset class or from another market altogether. For example, can often use information from the bond market in equity pricing model for the equity market. So the question that we're asking is, what is the informational content of the loan market? Obviously, you might ask, why should there be useful information in the loan market that can be used somewhere else or by investors? Financial institutions are typically known to have superior knowledge regarding the quality and risk of a borrower, at least in relation to
or positive, which shows that basically the local anomaly disappears after we control for characteristics. Like I said before, we're also interested in the coefficients from the second stage regression. And here you can see that the coefficients on these categories are all significant, which means these categories do provide explanatory power on the expected return of stocks. Further, when we control for both risks and the firm characteristics, the Hammer-Slow portfolio generates significant and positive abnormal returns, which is consistent with our argument that overweight anomaly can be explained by the firm characteristics. We also run this Fama and Macbeth 1973 regression, where we regress the 1 month excess return of stocks on their market betas and one of the 10 categories. the results show that most of these coefficients on the categories are significant, and the signs are consistent with the previous literature. What's more, when you control distress, jackpot, or the relation between beta and the future return becomes significantly positive, which is consistent with the prediction of Japan. Our last test is the multivariate analysis. To control for the firm characteristics in a time series regression, we create these aggregate firm characteristic indexes where we take the cross-section average of the corresponding indexes. And the result shows that after controlling for one of these 10 indexes, the abnormal return associated with the Hammond's law beta portfolio becomes insignificant. Our results still hold if we replace the left-hand side portfolio by this betting against beta factor proposed by Fresno and Peterson in 2014, which is a zero financing, zero beta portfolio that's buy low beta stocks and short high beta stocks. So to conclude, in this paper, we find that for the majority of the firm characteristics variables, high beta stocks differ significantly from the low beta stocks. In particular, high beta stocks are associated with higher probability of jackpot payoffs and distress risks than the low beta stocks. What's more, we find that after controlling for firm characteristics that can explain stock returns, the low beta anomaly disappears. And again, our results are robust among the tests that we conduct. So the implication of this result is that the systematic mispricing due to these firm characteristics could possibly reflect investor preferences for these firm characteristics that deviate from the traditional Japan prediction. And that's about our paper. Thank you.
Thank you. Did you have a comment?
Yes?
I have a question.
Sure.
Is distress like Altman Z, like when you look at the firm's distress, is volatility a measure of predict distress? Because I mean, beta is volatility, high volatility, right? And if you do like Altman Z, that firms that have high volatility have higher Altman Z.
Yes, yes.
So it is like, so you're saying firms with higher beta have higher distress, but by default they're going to have a higher default ranking just because they're higher, they have more volatility, right? Or are you actually finding that firms with high beta go into distress?
Our results shows that high beta firms associated with higher probability of being distressed. That's our result shows, and this is also consistent with the previous findings. Also, high beta firms are more volatile, that's true. But volatility, there's a low volatility anomaly again, which says that volatility is associated with lower return in the future. So I think that part is consistent with what we find here. So did I answer your question?
Well, no, I was just wondering if you were actually finding that those high beta firms actually go into financial distress, or is it more like a prediction of distress?
I don't do that because I don't have those bankruptcy data.
Okay.
But there's a paper by Campbell, Hilscher, and Shiani, 2008, where they use that kind of data to find that those firms that are more likely to be distressed tend to have high loadings in beta on the small minus big factor, on the high minus low factor, and they do generate a lower subsequent returns, which actually fits the description of the high beta stocks. So according to their findings, yes, high beta firms are more likely to be distressed, are more likely to get bankrupt. Yes.
Which would bring down their returns, right? Because if you have those losers in the
Well,
cycle,
usually,
you have a
according to the
negative.
literature, high distress should be associated with high return, because distress is another source of risk. And if you bear risk, you demand return. But what they find is that high distress risk is associated with lower subsequent return, which they call this low distress or distress anomaly.
Well, in the bankruptcy literature, it's because they fail. Because
Mhm.
before they fail, you have those negative returns before they actually fail.
Uh-huh.
So it's good that you don't have sample selection bias, because if the high beta firms have a lot of people who actually are distressed and actually fail, sometime during that portfolio, you're gonna have a lot, those ones that eventually fail are gonna have those negative returns. And so
Mhm.
that might bring the overall return down.
Yes, yes. Yeah, that's one thing I cannot ignore, but in our paper, we also show that other than the distress dimension of the firm, other firm characteristics could also predict or explain this low beta anomaly. So I think overall it won't have a material impact on our results. Yeah, but I understand your point, and thank you for mentioning that.
I mean, the other studies have that too, because
Mhm.
if these firms are, if a higher proportion of the high beta firms are going bankrupt, you're gonna have more firms with negative returns. Whereas the ones with low beta, if they're not going bankrupt, they may not have as high a return, but the averages may be
Well, speaking of that, actually there are also
that
papers.
long tail, that negative long
There are also
tail.
papers that discussing how hedge funds actually save or salvage these kind of firms that are in the process of bankruptcy or distress. And they find out with the help of these activities in hedge funds, actually some of the firms could actually survive this process and generate superior returns.
But they have negative before the hedge fund stable.
Well, if you think about the whole length of this company, well, sometimes they have negative returns, sometimes they have positive returns. If you're talking about this specific period, yes, they generate inferior returns relative to the home market and other firms. But here we're talking about like the whole sample size, whole sample period, not like specific period. So again, I don't think that would have a material impact on our results. Yes. Any other questions?
Thank you very much.
Thank you.
Thank you. This is going to be a tough presentation for me.
You won't need a clicker.
Yeah, but you will have to set it for now.
It's on.
It's already set? Many thanks to you. See, I am immobile. So when we put this chair, I'm thinking like this is a blessing for me. I hurt my back big time.
You hurt your back coming here.
Yeah, so it's
Yes, it's stand.
it's a big issue for me. So, how does it work?
You go forward.
So the title of the paper is The Effect of Bank Holding Companies Affiliation on the 2008 financial crisis, a joint work with Dr. Linda Pani and one of our PhD students, former PhD students, Fernando Peterson. Any flaw in this paper belongs to him. Anything positive is because of us. Okay, so this is directly coming from the testimony of Alan Greenspan, 2010, April 7th, where he says that it was global proliferation of securities, securitized U.S. subprime mortgages that was the immediate trigger of the current crisis. And then he goes further on contagion and talks about three particular points, which are mainly from the financial institutions. Talks about high leverage, talks about low liquidity, and the low capital adequacy of these financial institutions, and that's what kind of triggered all the mess we saw in 2008. Now, he bracketed all the financial institutions together, so then the question arises, is it that all financial institutions contributed equally? And then there are some papers based on this particular point where in 2009 paper, the finding is that no, some had engaged in bad quality mortgage while others did not. Then there was another paper by Blanchard, 2008, that they're essentially saying that some were better capitalized and lower leveraged than others. So it's not that it's a blanket thing where everyone is equally to be blamed for this financial crisis. What is our motivation? Our concern is about the organizational structure of the banks themselves. In essence, which structure is more for the root cause of this crisis? And when we say which structure, is it that the banks which belong to holding companies, they are to be blamed more for the financial crisis than those other banks which are unaffiliated or non-affiliated banks. There is some literature, in fact there is only one paper which we could find, 1977 JF paper by May, and she studies a difference between the holding company bank versus unaffiliated banks and points out the differences between these types of institutions. We are digging much deeper than what she had done. In her paper, what she did was she compared unaffiliated banks to any bank that is part of a bank holding company. Now, if a bank holding company has many subsidiaries, then there is something which we call diversification effect that takes place. So is it because of the diversification effect or is it because of the structure? That's not known. We are able to isolate that in this paper. Our sample size is much bigger than her sample size of 10%. Instead, we have almost all of the population of the bank holding companies. And then we are considering market measures of the risk also. Here are the summary of our findings. We find that overall holding company affiliation results in higher leverage, higher levels of home mortgage loans, both underwritten as well as underperforming, lower liquidity in these banks, and of course higher profitability. Now we dig deep into it and we isolate the publicly traded one bank holding companies, and then publicly traded unaffiliated banks, and there we find that this difference grows even further. This is what I was mentioning about when I said we are able to isolate the effect of one bank. There is one bank shell and just below there is one bank, and then you have multiple bank holding company where you have one holding company and then you have many banks below this. So we are studying only this one bank shell. In fact, if you look into Bank of America Corp, you will have one holding company. Below that, you have two holding companies, Banna Corp and NB Corp, and then there is Merrill Lynch. And within Banna Corp, you have Bank of America NA, which trades in the market, and then which is below NB, you have several others, and the structure doesn't stop there. It has multiple layers. So there is multiple layers of networking in this. So for us, this is what we are doing. We are studying only those which are one bank shell and individual banks, so that the differences we can allocate to the structure, not due to any effect of diversification. Now, why should the holding company matter? If you look into any regular, very simple balance sheet, we have a set of $100 here on the right hand side, and then we have the debt and liquidity, debt and the equity, and you have debt to equity ratio of 4. Now, if this bank is part of bank holding company, then that $20 is coming from the holding company, and that holding company again is taking $15 as a debt, so you have a debt to equity of 19. So the leverage can be enhanced greatly if a bank is part of a bank holding company. And then the moral hazard comes in that if you have lower portion in equity, you have limited liability, then there is a very strong incentive to take risk. So there is increased leverage for one bank holding company, will enable them to multiply profitability by the degree of leverage. What does this mean in the context of our sample period? These are our expectations. What we will see is that the balance sheet measures of risk will be higher. We are measuring several of those. The liquidity will be lower. The market risks should be higher for one bank holding company, and the profitability for these companies should be high too. This is our sample size. We get the data from Highline Financial 2008. There are 2,426 one bank holding company, and then there are 1,085 unaffiliated banks. The publicly traded sample size is much smaller, 153 one bank holding company and 116 unaffiliated banks. So what we do is the panel A has a loan mix, and we end up finding, those stars tell us that the home mortgage loans are written more by one bank holding company. Now, the non-performing portion also, we find that even though in some cases it's statistically insignificant, but the non-performing loans are also there more with the one bank holding company. The security mix is unclear. That's not the focus either here. Panel D tells us a lot of things. It says that the liquidity of the unaffiliated banks is much higher than the one bank holding company. The tier 1 ratio capital is also much higher for the unaffiliated bank than one bank holding company, because the debt to equity ratio much higher for one bank holding company than the unaffiliated bank. Both ROA and ROE are higher for the one bank holding company. Now what we do is we do regressions where we control for other factors which can influence all these dependent variables, and then we see the significance of the HC dummy. HC dummy is the holding company dummy, 1 if it is part of holding company, 0 if it is not. And here we are able to see that home mortgage loans, first lien and junior loan, both are positively and very highly significant, meaning that they are writing more of these loans compared to the unaffiliated banks. This is non-performing loans, and again, non-performing mortgages, both the junior as well as first one, is more at the HC dummy, that is where this is part of holding company. Panel D. Liquid assets, much more
comments for this discussion. For one hand, your sample is from 2008 only, and it's very good because you are focusing on this issue. And for the other hand, you mentioned that there is a real need for regulation in this issue. So, in this sense, it will be interesting to see whether after 2000 financial crisis, for example, the proportion of affiliated companies have been growing like you expected, and also to see whether your results, like the fact that bank holding companies have higher ratios, and to contrast the difference between 2008 and this moment. It will be very interesting in order to see the regulation team. The second
so I've got the notation in there that, and it's going to look fairly similar, except there's 2 steps now to get whether there's convergence. Well, the problem is many papers have been done on beta and sigma convergence, but very few on the more recent one, the log T, or what I call gamma convergence. So if you want to get published, you've got to use the latest of the tests, and that's what I've done. And it's also considered to be, well, I'm not going to, all the statistical reasons why this one is better than the other, and that's why Phillips and Sewell got this one published in 2007. It's the best of the convergence tests. Okay, I know this is going to be tough to read the numbers here, but for beta convergence, just to finish it, summarize it over the whole period, you have a negative number for conventional banks, and that's actually the intercept term, sort of like an intercept. And then the beta Islamic is whether the Islamic banks are any different. So basically what it's showing is that the Islamic banks are slightly different, but they're still converging. And post-crisis, 2010 to 2012, we still see convergence over time. So Islamic and conventional banks are converging towards similar values. Sigma convergence, the second of the tests, end result, the betas are going to be negative again. So we're going to see once more that, at least in terms of ROA, the ratios are such that banks are converging towards a common number, so there is convergence both in conventional and Islamic banks towards similar numbers. Oh, what I should have discussed here was my actual data set. It includes And why I skipped it over, I just skipped over a couple of slides. Sorry about that. The data set includes all countries where there's a dual banking system, where there are banks that operate both Islamic and conventional. So I believe I have data for, in this paper, for 17 countries, maybe 18 countries. It's what, 16? Okay, sorry. I can't even remember what I've got, and the main reason I can't is because I've got the net paper I'm working on right now has 25 countries, so I forget what I've done or haven't done, sorry. Anyhow, Sigma convergence supported, then we go to the more sophisticated test, and it kind of shows convergence only for Islamic banks. That is, that conventional banks are not converging towards a common norm across all countries. And this is going to be unreadable, undoubtedly. Maybe this is just to show what I've done. I've looked at gamma convergence for just a whole bunch of different ratios. In fact, for 17 different ratios. And for many of them, there is convergence towards common numbers, at least among the Islamic banks. Not necessarily as much among conventional banks. Okay, just to summarize all of this, instead of seeing tables and tables and tables, it's just Islamic banks are converging towards values of conventional banks. And what it means then, conventional banks are not converging across countries, but Islamic banks are converging towards the mean for conventional banks across, say, 17 different ratios. So what's going on, or how do you explain this? Well, what's happened is that during the global financial crisis, which didn't hit the Middle East until 2008, really. 2007 was a banner year for most Middle Eastern banks. So 2008, 2009 was actually the crisis there. Well, anyhow, the Islamic banks survived, and they argued they survived better and continued extremely profitable because of superior principles. So the idea behind this paper was to test, well, if they've got superior principles, et cetera, they should continue outperforming. Well, that's not the case. What's happened in 2009, 2010 is the Islamic banks were actually hammered much harder than the conventional banks. So what's been their response in 2010 through 2012? They seem to be mimicking conventional banks now. So that's how they're surviving and how they're moving more towards the mean across a whole bunch of ratios, including profitability ratios. So anyhow, that's the conclusion. The Islamic banks in recent years, from really 2010 onward, appear to be moving to be closer towards conventional banks. Not completely the same, but still somewhat similar. So I'll close there. Thank you.
Thank you. You surprised me, short 15 minutes. That's wonderful.
Was I actually short?
No, you were short 15. I didn't get a chance to write 2 more minutes.
Oh, okay. No, I usually can do this within the minute.
Very good. Okay. But our next presenter,
Can I discuss this paper?
of course, traditionally in this conference, the next presenter discusses the prior one. Okay, so you are discussing and then presenting. Okay. Sonal Tukra, am I pronouncing that?
Yes,
Okay.
you're right.
Is not in the document that we have. She's
I'm the joint author with Vanita Tripathi.
Right. So you are the co-author, but she is our guest. She is presenting the paper and of course discusses Dennis's paper. Okay, we are with you about 5 minutes for discussion and then 15 minutes for your paper. Okay, very good.
It's actually a very nice paper, and the uniqueness of the paper should what?
No, we are in trouble. When that goes there,
Okay.
push control, function, then one of the buttons at the top.
What did you press?
Okay.
Are we trying to bring up that past?
Yeah, we need it. Oh, you're here. Oh, that's
Oh, yeah, I was gonna
I think
say
it's
that.
F5, right? Function, is it F5? Okay.
I think so,
It's
yeah.
function F5.
Yeah.
I am a master of mishap.
Yeah.
Let's put it that way. Okay.
You got it up there?
No, we still don't have it. I thought we had it right, but
Yeah,
somehow
no, we just
it
wanna
likes
have
to
the,
switch. I
desktop
don't know
showing
why,
up.
but it likes to leave
You
us.
need, yeah, duplicate, yeah.
Let's see here. Arvin? Let's see. This mouse is actually, the computer is not working itself. Yeah, the computer's not working.
Yeah.
You're gonna have to restart the computer.
Takes
Sorry.
a few
That was at the
seconds.
time
It's
that you
a,
saved.
takes a few seconds to come.
Ah.
Yeah.
I could have talked for 5 more minutes, now I just, oh.
I feel bad, Dennis, that's okay. Don't worry, but we have to do the same thing. So we still haven't lost that.
Oh, yeah.
In your data, did you account for the valuation differences? If conventional banks use a certain amount of money, did you kind of measure that out with the Islamic banks too, or no?
Sort of. The definitions of all the variables have become kind of traditional. I've used bank scope data, and they've got a way of, so like a total interest that's received, it's not really interest, it's profit on interest-like investments. So yeah, I have, and it's all in US dollars, so the currency is comparable.
You know what?
Let's check right now.
Then do you think the rules and regulations as applicable to the commercial banks like CRR, SLR, do they also apply on these?
Absolutely,
They do apply.
yeah.
Okay. So the another question is that will government allow all religions to open separate banking systems with different set of regulations? Why is it so only for the Islamic banks?
You have a choice for conventional banks or Islamic. You can't
Yeah,
open
why
up
not
a
the
Hindu
other
bank or a Christian
Different
bank.
set of regulations
No.
for different banking systems.
Nope.
Okay. Also, one more thing, you can, what I found was you can even do the study in case of the emerging economies. Because as per FTSE classification, none of the country in the sample is an example of emerging economy. So this is one thing that I think you can come up with. Also, you can extend the sample period till 2014 or 15 as compared to 2012 because you have a good pre-crisis period, so you can even have it for the post-crisis period. And how does your paper improve on the existing research? How have you contributed besides, I think it was just the crisis period which you have been focusing on, their impact. And the last one, how to check for stationarity in your data, since you're talking about the mean reversal and all.
Yeah.
That's why have you taken the random effects model? Because to illustrate the impact of country-specific dummy sub-period, the IBs and CVs specific dummy and stock market listing dummy that you've taken, it can be best interpreted by employing the fixed effect model and not the random effect, what I think. It is because the difference in the dummies are reflected by the error terms in case of the random effect model, but the actual coefficient values for each dummy would be yielded when FEM is employed for the dummy difference analysis. So I have some doubt regarding whether the random effect should be used or the fixed effect should be used in this case. So I mean, these are the few observations on the paper.
Okay, thank you.
Show the stocks around the event date.
What ratio?
Turnover ratio.
Oh no.
Basically, the trading volume of the stocks around the event date. Are there like any advanced reaction from the market to this kind of information because you're talking about inside information, and the abnormal accumulates actually like I don't know 150 business days before the event. Is that correct? So I'm just wondering if there are some other players anticipate this kind of behavior and actually take advantage of this. So that, it's all about information asymmetry. Yeah, for example, if I know that, there's a pattern related to the stock prices, then I would act, on top of this and take advantage of this. I'm just wondering.
Any other comments, questions?
Any other comments, questions?
Very interesting paper, thank you.
Well, thank you very much. Thank you. That was a short
Very
concurrent
good.
session.
I would say very interesting paper as well as the English translation.
Thank you.
The backdating, I mean. The backdating.
I mean, is there something about, like, you choose the day to report to the SEC, so that you can pick a day where the price will be at the highest, something like that? Is that illegal or illegal?
I don't know, because I was looking on the
I
paper
don't
and they
have
had
access to the paper, so I'm not so sure about the dose.
Yeah.
But this time, I allow for stochastic volatility and variance premium to be priced. And this is the optimal leverage that I observe by calibrating my model to the data that we observe for the firms, and it's very close to the observed leverage. Now, why variance risk? Because we have other risks involved, and there might be other premiums, but why am I focusing on the variance risk? Because asset volatility is an important factor, both theoretically and empirically. It has been shown in the literature that asset volatility has a negative effect on the relationship, on the leverage of a company. In this graph, every dot represents a company's leverage and asset volatility. And I just fitted a constant line just to show that, well, what literature says makes sense in this naive look at the data. Okay? I'm going to get back to this graph later. Now, let's focus on this graph. What's this? On x-axis, we have the ratings of the company, which shows their risk level. So what's this? If you look at the risk levels of the companies and you assume that the volatility is constant, which is what most of the rating companies is apparently doing, this is what's going to happen. You're going to see that the observed asset volatility is low for AAA ratings, and it goes up and up when the ratings get worse and worse. And it's not my finding, it's already verified in earlier papers. Now, if you use these asset volatilities in a classical capital structure model and see what should be the optimal leverage, this is how the optimal leverage looks like. Well, it matches the intuition, right? Higher volatility, lower leverage should show up. So far, so good. Rating companies are doing their job. They measure the asset volatility correctly. They are rating companies with higher asset volatility lower, and companies with lower asset volatility have higher ratings. Right? Now, when you look at the leverage of this company, the difference is the under leverage. The AAA companies, they have lower leverage compared to B companies, which doesn't make sense. This also applies to BBB, because some people might say that, well, that's why they probably were rated B. But let's look at the BBB companies. They have higher leverage compared to the AAA companies. And when I'm talking about asset volatility, there is no financial risk involved here. Asset volatility is only taking out the financial leverage out and only looking at the business risk. And as you notice, it's not that all the firms are under-levered. Actually, the investment grade firms seems to be under-levered. And the reason is because of this constant volatility. So what do I do? In the earlier model, they assume that volatility is constant. Now I'm going to assume that it has a price risk. So risk-adjusted volatility, which is the one that you price and feel, is larger than the realized or the one that you observe for the assets, based on the historical observations. So using that, I show that when you don't include the variance risk premium in the models, but you plug in the variance risk premium on the right-hand side of a regression, the higher under leverage is correlated with higher variance risk premium for the firms. Then I show that with variance risk premia, for those firms that we just observed that they have high under leverage, actually their risk-adjusted volatility is much higher. So their observed volatility is much lower than the risk-adjusted one. And the gap, which is variance risk premium, is high for these firms. Now, what are these firms? Investment grade firms, IG stands for investment grade. Investment grade firms have this high variance risk premium and they are exposed to that. And the next question is that why investment grade firms? What makes them specific? I also look at it. It seems that investment grade firms are more exposed to systematic volatility. That's why they are having higher variance risk premium. Think of it this way. If there is an economic crisis happening, since these companies are exposed more to systematic volatility, they're going to be hit harder than the companies that they have lower exposure to systematic volatility. That's why they're afraid of taking too much debt. While the other companies who are not less exposed to the systematic volatility can take more debt. That's the idea. Now, empirically, I contribute to this literature and I show to the underleveraged literature, and I show that variance risk premium has something to say about the underleveraged, and investment grade firms which have high variance risk premium are a good candidates to contribute to this underleverage that has been documented earlier by the literature. I also show that, well, it's not a surprise because apparently there is this credit premium puzzle. Credit premium puzzle is the explained observed credit premium in the market. And interestingly, these investment grade firms are also over there in that literature contributing to the unexplained observed credit premium. And there are recent papers that they show that variance risk premium can explain that unexplained credit premium. So I'm saying that it's not a surprise. It's already being discussed in other literature, so why not we don't consider that in the optimal capital structure as? And theoretically, I contribute to the structural models of the firm, the models that consider the risk of the business and come up with advice for the capital structure of the company. And in those models, I add the stochastic volatility and I find the optimal leverage. And I am able to do that because I managed to find a closed form solution for the value of debt of a company, which helps me to find the optimal leverage. And I don't need to go through lots of complicated optimization problems. So that was the earlier graph that I showed you. Let me just give you more intuition and more information and be more formal at this topic of underleverage. So here, I'm gonna group these dots based on their ratings. And I'm gonna try to fit lines to them. So what are these lines? Each line represents the line that I try to fit to each dot that you see that belongs to the ratings. So let's say this line, which is the highest line, shows there is a negative relation between leverage and asset volatility for triple C firms which have low quality. The thick line represents the average, and as we go further towards the origin, the quality of the rating gets better and better. For example, this red dotted line is the AAA firms. Now, the dots that have connected in the middle is representing the average leverage and the average asset volatility. Remember that I showed you at the beginning a graph that shows low asset volatility and low leverage for AAA firms? That's what you see here. And as you observe high leverage and high asset volatility for example, B firms here. I'm just connecting those dots. And remember, this line and this dot represents the average. So what do we observe here? These investment grade firms are having below average behavior, and these firms are having above average behavior. Now let's divide this playing into two.